Let me ask you something. You wake up tomorrow morning, no credit card debt, no car loan, no student loan, no personal loan, nothing. Zero. Every single debt gone. How does that feel? Most people smile when I ask that and then immediately say, that's impossible for me. But here's what I've learned studying financial data for years. It's not impossible. It's actually a system, a proven, repeatable system that thousands of middle-class families are quietly using right now while everyone else is drowning in payments. My name is Henry. I'm going to show you exactly what happens to your life, your money, your mind, your career, your family, the moment you pay off your whole debt. This is not motivation. This is information. Real data, real families, real results. Let's get into it. Before I show you what changes, I need to show you where most middle-class families actually stand right now, because most people have no idea how deep the hole really is. According to the Federal Reserve's 2023 Consumer Finance Report, the average middle-class household in America carries $104,215 in non-mortgage debt. Break that down. Credit card debt, $8,942. Auto loans, $23,500. Student loans, $37,000. Personal loans and medical debt, $12,000 plus. And here's the number that should concern you the most. The average American spends 34 cents of every dollar earned on debt payments alone. Not rent, not food, not their children's future, just paying back money they already spent. Now, I want you to think about your own situation for a second. How much of your monthly income goes toward debt payments? If you're like most middle-class families, it's somewhere between 30% and 50%. That means you're working 2 weeks out of every month just for the bank. 2 weeks for free every single month. That's the reality. And that's exactly why paying off your whole debt doesn't just feel good. It completely restructures your financial life. Now let me show you how debt actually works, because the banks understand this perfectly, and most borrowers don't. When you take on debt, you agree to pay back the principal, the amount you borrowed, plus interest. Simple enough. But consumer debt uses compound interest. That means interest gets added to your balance, and then you pay interest on that interest, month after month, year after year. Let me give you a concrete example. $10,000 on a credit card at 22% APR. If you make only minimum payments, and most families do, it takes 27 years and 4 months to pay it off. Total interest paid, $18,600. You borrowed $10,000, you paid back $28,600. The bank made $18,600 off of one credit card from one family over 27 years. Now, multiply that across every debt in your household. This is what I call the debt tax. It's a tax you pay not to the government, but to financial institutions every single month, automatically, silently. And unlike income tax, nobody talks about it at dinner. Now, here's the other side of that equation. Every dollar of debt you eliminate gives you an immediate guaranteed return equal to your interest rate. Paying off a 22% credit card, that's a 22% guaranteed return on your money. No stock, no investment, no crypto. Nothing gives you a guaranteed 22% return. This is why I tell people before you invest a single dollar, eliminate your high interest debt first, because the math always wins. Now, there are 2 proven strategies to pay off debt, and I want to walk you through both. Strategy 1, the debt avalanche. List all your debts from highest interest rate to lowest. Attack the highest rate first. Pay minimums on everything else. When that's gone, move to the next. Mathematically, this saves you the most money. Strategy 2, the debt snowball. List your debts from smallest balance to largest. Pay off the smallest one first, regardless of interest rate. Build momentum, build confidence. Psychologically, this keeps most people motivated longer. My recommendation? For middle-class families with multiple debts, start with the snowball to build momentum, then switch to the avalanche once you've eliminated 2 or 3 smaller debts. The best strategy is the one you actually stick with. Now, let's talk about what happens when you finally cross the finish line. I want to tell you about a family I studied closely. I'll call them the Hendersons. Two working parents, two kids, combined income of $88,000 a year, a house in a decent neighborhood, two cars in the driveway. From the outside, solid middle class. From the inside, every month was a crisis. Here's how their money moved. Mortgage, $1,450. Two car payments, $860. Credit cards minimum payments, $390. Student loans, $410. Insurance and utilities, $820. Groceries and gas, $700. A total of $4,630 per month. Their take-home pay after taxes, $5,200. That left $570 for everything else. Emergency fund? Zero. Retirement savings? Paused. Kids' college fund? Never started. Then Mr. Henderson's transmission blew out. $3,200 repair. No savings, no emergency fund. They put it on the credit card. That was the moment. Not a dramatic collapse, just a car repair. That broke them. Mrs. Henderson told me later, we realized we were one problem away from disaster, and problems don't stop coming just because you're already struggling. That Tuesday night, sitting at the kitchen table, they made a decision. They printed out every debt they had, every single one, laid them on the table, and said, we are going to eliminate every single one of these, no matter how long it takes. 28 months later, every non-mortgage debt was gone. And what happened next is what this video is really about. Let me walk you through exactly what changed for the Hendersons and what the research tells us happens to families who reach full debt freedom. I'm going to break this into 6 areas because the changes go much deeper than most people expect. Change number 1, cash flow transformation. The moment the Hendersons paid off their last debt, they had $1,660 freed up every month. Not from a raise, not from a new job, just money that used to go to lenders now staying in their hands. Here's what that number actually means over time. $1,660 per month invested in an S&P 500 index fund at the historical average return of 10.1% annually. In 10 years, $337,000. In 20 years, $1,260,000. In 30 years, $3,700,000. From a family making $88,000 a year. No inheritance, no windfall, no lottery. Just redirecting money that used to go to banks toward their own future. This is the most powerful financial shift a middle-class family can make. Not picking the right stock, not timing the market, stopping the bleeding first. Change number 2, cognitive and mental clarity. This one surprises people most. A landmark study from Princeton University found that financial stress, specifically debt, reduces cognitive bandwidth by the equivalent of losing 13 IQ points. 13 points. That's the difference between making a clear, rational decision and making an impulsive one you regret. Debt occupies your mind even when you're not actively thinking about it. It creates background noise that never fully turns off. It affects your sleep, your focus, your patience with your family. When the Hendersons became debt-free, Mrs. Henderson described it as, "My brain felt quiet for the first time in years." Research published in Psychological Science confirms debt elimination reduces anxiety symptoms by up to 25%. That's not a small number. That's meaningful, measurable relief. And here's the business case for mental clarity. Clearer thinking leads to better decisions. Better decisions compound over time. The return on a clear mind is impossible to calculate, but it's real. Now, here's something I want every working professional to understand. Debt is a leash. When you owe money every month, you cannot afford to take risks. You cannot walk away from a toxic workplace. You cannot say no to projects that drain you. You cannot negotiate aggressively because losing the job is not an option. You need that paycheck, no matter what it costs you. Mr. Henderson had wanted to start his own HVAC business for years. He had the skills, he had the contacts, he had the plan, but with $1,660 going out every month in debt payments, one bad month could destroy his family. 6 months after becoming debt-free, he launched his business. First year revenue, $112,000. Not because debt freedom gave him the skills, he already had those. It gave him the safety net to take the risk. When your monthly survival cost drops dramatically, the stakes of entrepreneurship drop with it, and suddenly risks that were impossible become calculated. This is why I believe debt freedom is the foundation of wealth building, not the reward at the end of it. Now, let me give you a statistic that most finance channels don't talk about. According to the American Psychological Association, money is the #1 source of conflict in American marriages. Not communication, not trust, money. And the primary driver of that money stress is debt. When you carry debt, every purchase becomes a negotiation. Every financial decision carries tension. Date night feels guilty. A new pair of shoes becomes an argument.
The Hendersons told me that in their debt years, they had the same argument every month. Different trigger, same argument. After becoming debt-free, those arguments stopped. Not because they had more money, because they had less fear. Financial peace changes the temperature of a household, and children feel it, even when they don't understand it. Change 5. Physical health. This one is backed by hard science. A study published in the journal Social Science and Medicine found a direct correlation between debt levels and physical health outcomes, including blood pressure, sleep quality, and immune function. People carrying high debt levels are 46% more likely to report high blood pressure, 27% more likely to report poor sleep, more likely to skip preventative health care due to cost anxiety. When financial stress decreases, cortisol levels drop. Sleep improves. The immune system functions better. Debt freedom is literally a health intervention. Change 6. Long-term wealth trajectory. Here's the final and most important consequence. Debt-free families don't just feel better, they build wealth at a fundamentally different rate, because every dollar that used to go to interest payments now goes to assets. The Hendersons, in the 5 years after becoming debt-free, built a 6-month emergency fund, maxed out Roth IRA contributions every year, started a college fund for both kids. Mr. Henderson's business grew to $340,000 annual revenue. None of this was possible with $1,660 going out every month to lenders. The math is simple. The execution is hard, but the result is compounding, not just financially, but in every area of life. So let me bring this together. Paying off your whole debt is not just a financial event. It is a complete life restructuring. It changes your cash flow. It changes how your brain operates. It changes the risks you can take in your career. It changes your marriage, your health, your children's environment, and your long-term wealth trajectory. But here's the truth I want to leave you with. The system, the banking system, the credit system, the consumer economy, was not designed for you to become debt-free quickly. It was designed for you to carry debt comfortably for decades. The minimum payment was not created to help you. It was created to maximize the interest you pay over time. The families who escape the system, the ones who make the decision that the Hendersons made at that kitchen table, they don't just become financially stronger. They become free in a way that money alone cannot buy. And that freedom, that is the real asset. Not the savings account, not the investment portfolio, the ability to live life on your own terms. That is what paying off your whole debt actually gives you. Now, I want to hear from you. What is the one debt right now that if it disappeared tomorrow would change your life the most? Drop it in the comments below. Credit card, car loan, student loan, whatever it is. Because sometimes just writing it down, naming it, is the first step toward eliminating it. If this video gave you value, share it with one person in your life who needs to hear this. One family member, one friend, one colleague, because the information in this video could genuinely change the direction of their financial life. I'm Henry, and I'll see you in the next one.